I need to start by being brutally honest with you, something almost no one in this business is willing to admit right now. I am scared. Not the kind of scared that paralyzes you, but the kind that triggers every instinct you've honed over decades of watching markets move. The kind that only comes around 3 or 4 times in a career. The last time I felt this sharply, this deeply rooted in real data and structural signals rather than just noise, was 2007. And we all know what followed in the years after. Right now, what China is doing, the moves they are making, the signals they are sending, the economic structures they are quietly dismantling and rebuilding has triggered that same alarm inside me. This is not fear for the sake of drama. It's the type of warning you cannot ignore, and I won't pretend otherwise. It's time to lay out what's happening in a clear, unfiltered way, because the truth is uncomfortable, but it is what every serious investor needs to hear. Let me remind you of a principle I've emphasized for years, because it underpins everything I'll walk you through. The single most important factor in global markets is not earnings, not Fed policy, not even interest rates in isolation. It is liquidity. Where is it flowing? Is it expanding or contracting? Who controls the spigot? For 30 years, the answer was simple: the United States. The dollar dominated as the global reserve currency, and American capital markets were the deepest, most liquid in the world. When the U.S. sneezed, the rest of the world caught a cold. This framework guided every macro trade I made from the 1980s through the early 2000s. It worked until it started being challenged. What China is doing now is, in my view, the most deliberate and structurally consequential challenge to that framework in my lifetime, and the market is nowhere near pricing it in. On the surface, you see the trade war headlines: tariffs, counter-tariffs, export controls, diplomatic tensions. That's all real, and it matters. But it's just the tip of the iceberg. Beneath the surface is a multi-year methodical campaign to reduce China's exposure to the dollar-based financial system. Think about that. Trillions of dollars in U.S. Treasury holdings, once a rational choice to park export earnings in the safest, most liquid asset on earth, are now being reassessed. After watching what happened to Russia, after seeing the U.S. freeze Russian central bank reserves almost overnight, China's leadership made a cold, calculated decision. Dollar reserves are not an asset. They are a liability. They are a hostage. China has been quietly converting those reserves into gold, bilateral currency agreements, and building a parallel financial system capable of operating independently of the dollar. Pause for a moment and let that sink in. China is the second largest economy on earth, the largest trading nation, and the biggest foreign holder of U.S. Treasuries. Their decision to reduce dollar dependence is not incremental, it is seismic. Changes of this magnitude don't hit markets overnight. They build gradually, then tip, and when they do, the movement is swift and often shocking to the majority of investors. I've seen this pattern play out countless times across currencies, credit, and equities. A slow buildup of imbalance, followed by sudden, violent correction. Let's look at some specific data that is particularly alarming. Chinese central bank gold purchases are at unprecedented levels. This isn't speculation or a bet on gold prices rising. It's a strategic move, repositioning national reserves into an asset that no foreign government can freeze or weaponize. That alone is a statement about China's view of the world. Next, consider the push for internationalizing the yuan. Petro-yuan deals with Gulf states, yuan-denominated commodity contracts, bilateral currency, swap lines across Asia, Africa, and Latin America, all small individually, but collectively, they point toward a long-term strategy. If this trend continues over the next 5 years, we could see a world where a significantly larger portion of global trade settles in yuan and gold, and the structural support for U.S. Treasuries diminishes. And then there's China's domestic economy, which is arguably the most immediate risk for 2026. The property sector, once roughly a quarter of GDP and a major component of household wealth, is in a slow-motion collapse. The government has tried interventions, liquidity injections, and credit support for 3 years, but property prices in major cities continue to fall. Developers' balance sheets remain impaired. Local governments reliant on land sales are under severe fiscal stress, and household confidence is deeply shaken. This is not a problem that stays confined to China. Its massive role in global supply chains and commodity demand means a deflationary contraction there spreads across the world, impacting economies everywhere. Now, consider the interaction of these threads. China is deliberately reducing its Treasury holdings at the same time the U.S. faces record peacetime deficits, needing to issue enormous amounts of new debt. Supply is rising, demand is shrinking. Basic economics predicts yields must rise. When Treasury yields rise, everything priced off the risk-free rate equities, corporate bonds, real estate, private equity is repriced. Layer on the vulnerabilities in the U.S. financial system itself. Corporate debt is historically high relative to GDP, much of it issued at rates far below today's reality, creating massive refinancing risk. The companies most at risk aren't the mega-cap tech names everyone watches, but the middle-tier businesses that are large enough to carry significant debt, yet not strong enough to absorb an interest shock. Sectors like commercial real estate, retail, media, and healthcare services are most exposed. When slowing revenue growth meets rising debt service costs, the outcome is predictable, and it isn't pretty. I expect waves of corporate distress here, and that will be the trigger that finally forces equity markets to confront reality. So, what does this mean for you right now, in practical terms? I'm not here to scare you for entertainment. I'm here because the next 90 days could change everything for your savings, your retirement, your investments. The kind of change that feels sudden but is actually the culmination of slow-moving, structural forces we've been ignoring for years. The first rule is simple. Liquidity is king. You need to know where your money is, who controls it, and how fast you can move it if markets shake. Cash in weak banks or assets that rely on continuous credit expansion is no longer safe by default. Let's break it down. U.S. Treasuries are widely regarded as the safest asset in the world. But safety is relative. If China and other foreign holders continue to reduce their holdings, the U.S. government will need buyers elsewhere, and yields will rise. When yields rise, the market value of existing treasuries falls. This is textbook duration risk, but few retail investors understand how quickly it can erode wealth. If you hold long-term treasuries thinking they are immune to loss, you are exposed in a way most people never calculate. Equities are even trickier. The S&P 500 has performed impressively over the last decade, but the composition of that index hides a structural fragility. Growth stocks with high debt, startups riding leveraged optimism, and companies dependent on cheap capital face enormous headwinds. When interest rates rise and liquidity tightens, multiple compression hits first, then earnings misses amplify the pain. And it's not just domestic global exposure matters. Companies with supply chains heavily reliant on China, Southeast Asia, or commodities linked to Chinese demand will see real revenue impact before most analysts adjust their forecasts. Now, let's talk about an asset class most investors overlook: commercial real estate. In the U.S., CRE is a ticking time bomb. Office vacancy rates are skyrocketing as hybrid work models persist, and retail continues to consolidate under e-commerce dominance. Debt maturities are high, and refinancing at today's rates is not feasible for many. Defaults will rise, and banks holding this exposure are not immune. They will tighten lending, causing ripple effects in small and mid-cap businesses. This is where I expect the first real shock to confidence in financial markets. The second rule for the next 90 days: diversify, yes, but with strategy. It's not enough to scatter your investments across different ETFs or index funds. You need to stress test every holding against a scenario where liquidity contracts sharply, the dollar weakens moderately, and yields rise aggressively. Some traditional safe havens, gold, certain commodities, currencies outside the dollar system could benefit dramatically. Not as a gamble, but as insurance against systemic risk that is quietly building. I've been asked repeatedly, Stanley, should we sell everything? Should we panic? My answer is always the same. Panic is never an investment strategy, but preparation is. Understand where your exposures are. Reposition capital toward assets with intrinsic liquidity, proven resilience, and defensive qualities. This is not just about surviving a market pullback, it's about positioning yourself to thrive when others are scrambling to exit. Let me give you a concrete example. In 2007, I noticed liquidity was tightening in the subprime mortgage market before most professionals even acknowledged it. I repositioned our portfolios incrementally, not all at once, into safer, liquid assets. When the crisis hit in 2008, we weren't just protected. We were in a position to invest aggressively at valuations nobody thought possible. History doesn't repeat exactly, but it rhymes. The signals I'm seeing today echo that same rhythm. This is why I'm moving decisively and why I urge you to evaluate your own positioning with equal seriousness. Finally, consider behavioral factors. Humans are notoriously bad at adjusting to structural shifts until the pain becomes personal. Most people will only react after seeing headlines of major defaults, layoffs, and market volatility. By then, the moves you can make will be reactive, expensive, and limited. Acting now, while there is clarity, while the signals are still intelligible, is what separates the informed from the reactive. I need to be clear. This is not about timing the market perfectly. It's about understanding the forces in play and acting deliberately. The next 90 days are critical because they are when these imbalances already brewing for years may accelerate in a way that surprises most investors. Markets hate uncertainty, and the combination of rising yields, China's structural moves, and corporate vulnerabilities is as potent a cocktail of uncertainty as I've seen in my entire career. So, here's what I want you to take away from today. Pay attention to liquidity, reassess your Treasury and equity exposure, stress test your assets against rising yields, and consider defensive, liquid alternatives. This is not hype. This is a strategic wake-up call rooted in decades of experience, data, and observation of patterns few people are trained to recognize. Ignoring it is not ignorance, it's risk. Let's talk specifics because general advice only gets you so far. The sectors I'm watching most closely for distress in 2026 are not the headline tech giants that dominate the news cycle. It's the middle tier, the companies big enough to carry substantial debt but not large enough to absorb interest rate shocks. Think commercial real estate, retail chains, mid-sized industrial firms, healthcare services, and media companies that relied heavily on cheap capital to fund expansion. These firms are the canaries in the coal mine. When refinancing costs rise, when revenue slows, when consumer confidence wavers, these companies will experience the crunch first, and their troubles will ripple through the broader market. Here's the mechanism I'm watching that could turn a series of isolated issues into a systemic shock. As credit stress appears, credit spreads widen. The cost of borrowing rises across the corporate spectrum. Investment slows, hiring slows, consumer confidence softens, revenue growth disappoints, earnings get revised downward, equity markets reprice. And as the wealth effect diminishes, consumer spending, the backbone of the U.S. economy, takes another hit. This feedback loop, sometimes called a doom loop, has played out before, and when it does, it happens faster than anyone anticipates. The Federal Reserve, which in past crises could step in to cut rates and flood the system with liquidity, is more constrained than it has been in decades. Inflation, while seemingly under control in headline numbers, remains embedded in structural forces: deglobalization, energy transition costs, labor market shifts, and fiscal deficits that aren't going away. If the Fed acts aggressively to stabilize markets, it risks reigniting inflation, undermining its credibility, and triggering further volatility. The assumption that the Fed will always have your back, the so-called Fed put, is no longer a safe bet. Now, consider the global dimension. China is not just playing a domestic game, it's deliberately pressuring the dollar system, reducing its holdings of U.S. Treasuries, building parallel financial networks, and internationalizing the yuan, all while managing internal economic pressures, creates a perfect storm for global credit markets. When a major Treasury auction fails to attract buyers or foreign participation drops, it won't just be a U.S. problem, it will be a signal that global liquidity is shifting in ways markets are unprepared to price in. Technology adds another layer. The U.S.-China tech confrontation is about more than trade. It's a strategic war. Export controls on semiconductors and chip-making equipment from the U.S., paired with China's restrictions on rare earth minerals and critical inputs, are forcing both economies to spend hundreds of billions rebuilding domestic supply chains. These costs don't disappear. They flow into corporate margins, consumer prices, and government budgets. This structural inflationary pressure, combined with rising interest rates and liquidity shifts, intensifies the risk of a sharp market correction. So, what is the actionable takeaway? First, identify vulnerable positions in your portfolio. Stress test your equity exposure, particularly in leveraged mid-cap sectors. Second, consider insurance. Options on major indices provide asymmetric protection against tail risks. Third, real assets like gold, energy, and other commodities with intrinsic value outside the dollar system are strategic hedges. Fourth, hold more cash than feels comfortable. Cash is not a passive asset in this environment, it's optionality, the ability to act decisively when prices are dislocated. Finally, think independently. Consensus in the markets is overwhelmingly optimistic that China's risk is managed, the Fed has room to maneuver, and the soft landing will materialize. History has shown me that the consensus is wrong at every major turning point. Waiting for confirmation before acting is a mistake. The real opportunity and the real protection comes from analyzing the signals, understanding the structural dynamics, and positioning ahead of the panic. The lesson is simple. Markets move fast once structural imbalances reach a tipping point. Those who wait until the headlines scream crisis are already too late. Those who understand the data, the global shifts, and the vulnerabilities, and act on that understanding with calculated precision will emerge not just unscathed, but positioned to take advantage of the inevitable market dislocations. Let's get into the specifics of how I am positioning myself in this environment, because understanding theory without action is only academic. I am not betting on a total collapse of the U.S. economy. That is never the trade. What I am doing is constructing asymmetric positioning for both the short-term panic and the long-term structural shifts. I am long volatility in targeted ways, increasing exposure to gold steadily, and short credit in the over-leveraged middle-tier sectors I previously outlined. These are the companies with high refinancing risk, insufficient cash flow, and limited balance sheet strength to absorb rising interest expenses. Simultaneously, I am long the dollar selectively in certain cross rates. This may seem counterintuitive given the long-term trend against the dollar, but history shows that in moments of global risk aversion, capital flows into the dollar as the safest liquid asset. This short-term panic trade can occur even as the structural story for the dollar remains negative. Understanding the difference between the panic trade and the long-term trade is critical. It's what I mean by asymmetric positioning. Cash is another tool I am prioritizing. Holding more cash than usual is uncomfortable in a rising market, but in a dislocation, cash becomes optionality. It allows you to buy assets at prices that don't exist today, but will emerge when the market shifts violently. This is not speculation, it's preparedness. The dislocations are coming, and being able to act decisively in real time is how generational wealth is created and how losses are avoided. I am also monitoring 3 critical signals that will indicate when the next phase of stress is underway. First, credit default swap markets, specifically investment-grade CDS spreads. When the cost to insure high-quality corporate debt starts rising in ways that aren't fully explained by macro rates, it's a signal that sophisticated credit investors see systemic stress building. Second, Treasury auctions, weak demand, declining bid-to-cover ratios, and falling foreign participation are signs that the structural shift away from U.S. debt is underway. Third, currency markets, specifically the yen and the yuan. Japan, as the largest foreign holder of U.S. treasuries, could trigger seismic shifts if it reduces holdings, while significant yuan depreciation could unleash a deflationary wave globally, landing with particular force on American corporate earnings. Technology must also be considered in this confrontation. The U.S.-China dispute is fundamentally a technology war. The U.S. has restricted exports of advanced semiconductors and chip-making equipment to slow China's progress in AI and high-performance computing. China has retaliated with controls over rare earth minerals and other critical inputs essential to U.S. technology manufacturing. Both economies face extraordinary costs to reorient supply chains domestically. These costs are not temporary. They flow directly into margins, government budgets, and consumer prices. They are structural, not cyclical, and their effects will be felt for years. Now, I want to address the bull case because it is important to be intellectually honest. Some argue China is too rational to risk destabilizing global markets, that the Fed can still manage rates without reigniting inflation, and that the American economy and consumer resilience will absorb shocks better than pessimists expect. I take these arguments seriously. They are not baseless. But what I am observing is that the probability distribution of outcomes has shifted materially toward the downside. Markets are not appropriately pricing that risk, and the asymmetric opportunities favor defensive and hedged positions. Understanding China's mindset is crucial. President Xi is not making decisions based on quarterly growth or consumer confidence polls. He operates on a decades-long strategic timeline with a vision of China as the dominant regional power and a peer global competitor by 2049, the centenary of the People's Republic. Short-term economic pain is acceptable if it strengthens long-term objectives, reducing dependence on the dollar, building alternative financial infrastructure, and asserting technological independence. This long-term strategic thinking is a dimension that Western markets consistently underestimate. Reflecting on my personal experience reinforces this perspective. In 1999, I was told tech valuations didn't matter and the boom would last forever. In 2006, I was told national housing prices couldn't fall. In both cases, well-informed, intelligent people were catastrophically wrong because they were analyzing the new reality with outdated frameworks. That same dissonance exists today. The analytical lens built on 30 years of dollar dominance, Fed omnipotence, and globalization is obsolete. Investors who recognize this first and adapt will position themselves on the right side of what I believe will be the most significant macro shift of the next decade. Looking ahead to 2026 specifically, I anticipate the first half of the year will reveal credit stress clearly enough to be undeniable. This will likely manifest as a series of high-profile corporate distress events in the vulnerable sectors, forcing broad credit repricing. In the second and third quarters, equities will begin to reflect this stress, particularly the most expensive growth and momentum stocks. A weak Treasury auction combined with a currency event, either a meaningful yuan devaluation or dollar strengthening, could catalyze a rapid, disorderly deleveraging akin to a market crash. I want to be completely transparent about the uncertainty here. I do not know if the events I am describing will play out in the first half of 2026 or the second half. I do not know if the market impact will be 30%, 50%, or something else entirely. I do not know with absolute certainty that China will be the precise trigger rather than another unforeseen catalyst. What I do know is that the structural vulnerabilities in the global and U.S. financial systems are real, and in several important dimensions, they are larger than in 2007. Yet the market is priced as if they do not exist. That combination, large structural vulnerability and complacent pricing, is historically what creates the conditions for a crash. While the exact timing and catalyst are uncertain, the eventual outcome in this context is almost never uncertain. So, what should you do? First, evaluate your exposure to the most vulnerable areas: expensive growth equities, highly leveraged companies, and sectors sensitive to higher rates and slowing global growth. Do it analytically, not emotionally. Second, consider insurance via asymmetric instruments. Options on major indices are expensive in absolute terms, but relative to the tail risks, they offer valuable protection. Third, increase exposure to real assets. Gold first, energy assets second, because they carry intrinsic value outside the dollar system. Fourth, hold more cash than feels comfortable. Cash in a crisis is not a waste. It is the ability to seize opportunities at prices that are impossible today. Finally, think independently. The consensus view is that soft landings are real. The Fed can manage rates, China is a managed risk, and current market valuations reflect fundamentals. I am not saying the consensus is wrong with certainty. I am saying it has been wrong at every major turning point in my career. The time to question prevailing narratives and form your own analysis is before the turning point is obvious, not after. Investors who made generational wealth in 2009 did the work in 2008, acted in the face of fear and uncertainty, and held their positions even when everything seemed to suggest they were wrong. That is the courage and preparation this moment demands. What China has triggered is more than a trade dispute or geopolitical tension. It is a fundamental challenge to the financial architecture that has underpinned U.S. prosperity and market valuations for over 80 years. This will play out over years and decades, but the market impacts will appear in concentrated, violent episodes. I believe one of those episodes is coming in 2026. Be ready, prepare, think clearly, and do not let complacency make decisions for you, because in investing, complacency is always punished. Right now, across global macro markets, complacency is everywhere. If this analysis changed the way you think about the world today, share it with someone who needs to hear it. Understanding these dynamics matters. The more people who grasp the forces shaping our financial future, the better prepared they will be for whatever comes next.